In this video, I'll be giving a buy-side analysis of a fantastic video that was put out by POTOMAC, particularly Paul. If you can see here, this is Paul, done a great sell-side masterclass on how a business broker and a seller is thinking when they're selling their business. So let's get straight into it.
Probing problems, finding solutions, finding common ground, getting to yes. At the end of the day, though, when you're selling a business, it's not that simple. And what we're going to talk about today is some of the dynamics and the skills that are required to be a great negotiator, because in my mind, all else being equal, the best negotiator is going to really be able to maximize the value of his or her business, right?
So he's saying it's not that simple when it comes down to analyzing negotiation from the perspective of all of these books which are available on negotiation. And he's entirely correct, because a business is a different type of asset to a property or something like that. A business doesn't have a set price, which he'll go through in this video, of course. It's arrived on the negotiating table, as Paul says. But the seller is trying to achieve the best price possible for their business. They're trying to maximize the value of their business to achieve as much as they can on their exit. And of course, from a buyer's perspective, we're trying to achieve the best price that we can, which means the lowest price, which gives us margin of safety. And of course, we're not trying to rip people off, but we're trying to pay fair prices so we can get a good return on investment when we're going to an M&A transaction. So of course, when it comes down to negotiation in M&A, there's certain other tactics and strategies that you need to understand when you're going into a particular M&A transaction.
And so understanding the dynamics at play, and also understanding how to create a formal sell-side process, because negotiation really is a process. And I think if you read some of the literature, you'll quickly see that negotiation is in itself a process. So understanding the process, how to be a process setter, how to control that process, will, for you as a seller, put a tremendously greater amount of cash in your pocket.
Now, the process from the sell side is something which the broker tries to control. And from a buyer's perspective, you're trying to break that process as much as possible, because it keeps the sellers and the brokers on their toes as to what's happening with this buyer. Is this buyer trying to make the rules themselves? And if you can do that from a buyer side perspective, then you're able to get into the mind of the broker, you're able to get to the mind of the seller to say, right, this person is not following the process. However, they are pushing the deal forward. So from a sell side perspective, they're following a particular process. From buy side, we need to follow our processes. Our process is to ensure that the steps that we take are able to give us control of the process itself. So the more that you know about controlling the process of a transaction, then you will be able to get the better result than the seller or the broker.
Before we talk about negotiation in and of itself, I wanted to talk a little bit about valuation and price. You know, a business is not like a pack of batteries, right? It's got a price tag on it. You go into the store, it's $6.99, you buy it. A business doesn't have a price tag. The price of a business is arrived at the bargaining table through negotiation. And so, all else being equal, the better you are at negotiating, the likely higher price you're going to get and the better terms you're going to get for yourself.
So he's correct that a business doesn't have a price which is attached to it, just like something when you go to the shop or property or something like that. However, there are 4 valuation perspectives that you can use. And I'm not talking about valuation methods on, is it 2 times multiple, 3 times multiple? I'm not talking about that. There are 4 sort of approaches to valuation. So the first one is intrinsic value, and that's the minimum that you would pay for a business, or what you would there's no minimum that you would pay for a business, but that's the minimum that a business would actually be worth from a objective perspective. The second one is fair market value, which is another approach. The third one is negotiated value, in which Paul will be going throughout this video, and he'll also be going through the 4th approach, which is strategic value. Now, sellers are trying to achieve strategic value, where we're trying to achieve intrinsic or fair market value. And sometimes in a particular transaction, there may be a business which is a fantastic business and you might want to go to negotiated value. But from a buy side perspective, you never want to go to strategic value in valuing a business and paying for a business. So although he's correct that there is no particular price for a business, no particular valuation for a business, but we from buy side perspective try to stick to the intrinsic and fair market value valuations and prices, and of course sellers try to achieve negotiated value and strategic value prices and valuations.
Today, we're going to craft a formal sell-side process, and I'm going to take you through what an investment banker does, or a sell-side advisor, when he negotiates a sell-side M&A deal, so the sale of a business. But before we get into that, I wanted to discuss a lot of aspects to negotiations that people really don't talk about. And there is somewhat of a structure to this, and when you think about negotiations in general, some components that come to my mind instantly, and one of the most important is leverage or power. And I will use those interchangeably today throughout our discussion. But when I talk about leverage, I tend to break that down into a variety of different factors, right? For example, you could have leverage against the other side by using deadlines that impact them and don't impact you. You know, if you think about a labor negotiation, right? We're going on strike. It's happening tomorrow at midnight, and all of the concessions tend to happen right before midnight. That's a deadline that impacts both the buy side and the sell side effectively. But you also have deadlines that would only impact one side. So, for example, if you want to buy this business, you have to tender an offer by 5 p.m. on Friday. Otherwise, we're not bringing you into the process. You're out. You have no opportunity to be able to buy the business. That doesn't affect you, the seller. It affects the buyer. And so time is one attribute to leverage.
So time is a very, very important aspect that you can use both from sell side and buy side as well. So he's talking about tendering bids on a particular deadline. From a buy side perspective, the way that you can hinder that process to ensure that you can achieve something which is outside of their process is to make offers maybe a little bit earlier. So if they say, for example, even before they say you have to tender a bid by this time, you just make an offer as soon as possible. So when I say make an offer, you indicate interest of an offer. So of course, Paul's going to go through something which is called indication of interest, which is basically just showing that, yeah, you're interested in the particular transaction. So you can break their process by following your own process and doing it on your terms. And when you do it under your terms, then most sellers will look at that and they will start taking you seriously. Now, one thing to highlight as well is that Paul is talking about mid-market size businesses and above. Now, most of the people that I talk to are buying businesses which are small businesses and lower middle market and mid-market businesses. So that's classified as any business which is doing 50 million in revenue or less. Brokers, sellers are not normally following the process that Paul is laying out here. They're not following the process at all. So that gives us the advantage that we're able to use our own timelines and our own leverage and power to ensure that we can get the best prices for our businesses that we are looking to acquire.
Another attribute to leverage that's extremely important to consider, and probably in my mind the most important, is optionality or competition. And I'll use those two terms interchangeably. Whenever you have an asset and you increase the number of buyers that are vying to acquire that asset, you're naturally going to raise the price. I mean, if you think about a public auction, right, and you're selling a Van Gogh painting, if you've got one buyer sitting there with his paddle out in the audience versus 100, it doesn't take a whole lot of common sense to determine you're in much better position having a lot of buyers out there, right? So competition is an extremely important aspect of leverage. But there are other aspects of leverage that are somewhat...
Right, let's talk about competition. Now, as a buyer, you do not want to get into a bidding war for a business. And the best way to avoid a bidding war is number one, to do off-market deals. So don't go for on-market deals. Any on-market deals, it's on the open market, there is an opportunity for other buyers to get involved in that process. So from a buyer's perspective, if you do off-market deals, you won't be involved in dealing with other potential buyers. But for example, even if you are doing an on-market deal or you're doing an off-market deal and other buyers are now in the picture, you need to wow the seller in other ways. So if you can show that you're the best person to buy their business, when I say best person, it's either you as an individual or your business, you're the best business to buy their business or you're the best person to buy their business, then you are working on factors other than price. So price now becomes another factor, and your competitive advantage, or the fact that you are a safe pair of hands for their business, or the fact that you have some sort of product or service offering, or some sort of staff progression program, which is different to other people, that is also something that you can use to ensure that you set yourself apart from other buyers. And sellers really do appreciate that. I know that firsthand experience. We've been in bidding processes from with other buyers as well, and we've won based on factors other than price. And the clients as well, they've won based on factors other than price.
Under the surface. And those are aspects such as necessity or desire. So when I think about necessity, it's not often that somebody's in a position where they have to sell their business. Now, it happens from time to time. I've seen business owners pass away and the family being stuck with a massive estate tax bill and being forced to sell. Right? So that does happen. Deaths, divorces could, maybe not create necessity, but at least a strong desire to dispose of an asset.
So you want to be in those positions where you're on buy side when the seller's on that side. So if, for example, someone's very old and they need to retire, someone's very sick and that they need to, they need to essentially, they can't carry on in the business. Or like he said, Paul said, in a divorce, or we want motivated sellers. And if you're dealing with a seller and they're not motivated, and I mean quite extremely motivated, it's very, very difficult to deal with that particular seller from a buyer's perspective. There's so many things that can go wrong other than them wanting a high price for their business. So Paul now, I think he's going to talk about that sellers shouldn't be motivated or shouldn't sort of show people that they're motivated to sell their business, and therefore they can achieve a higher price. And of course, from a buyer side perspective, you only want to deal with motivated sellers. If you're not dealing with a motivated seller, move on to the next business. There's plenty more fish in the sea, as they say.
Necessity comes to play. So, for example, if I had a business and I wanted to sell it, and you came to me and said, "Hey, Paul, I'd really like to buy your business," and I needed to sell for whatever reason. Let's say that if I didn't sell it, I was going to go bankrupt because I have a lot of loans I've got to pay off. Well, the last thing that I would do as a seller is tell you that this is a forced sale or a fire sale, right? I mean, that would dramatically undercut the leverage in our discussion. So I would want to conceal that fact.
From a buyer's perspective, when you're speaking to sellers, you really want to extract that information. You need to understand exactly why they're selling the business. And all sellers will most sellers will conceal that, as Paul's just mentioned. Your job as a business buyer is to extract that information as much as possible. So probe into their answers as much as you can. So if, for example, you're speaking to a seller and they're saying that, okay, I'm coming up to retirement age, fair enough, that's fine. But if a business is running by itself, maybe it's got managers and it's being staff run, then why don't they just keep the business running? So go in deeper and then you can find out, right, I need to retire, but also I've got an illness, or my wife's got an illness, or my husband's got an illness, or I've got a young family, or something like that. And then or not young family, that would be for younger people. But anyway, It's about uncovering the actual reason, the actual motivations for selling the business. And Paul mentioned actually one of the best deals that you can get, or best type of seller that you can get, is when the actual owner of the business has passed away and the children have inherited the business. Either they got a large tax bill that they need to pay, or they got their own lives and they don't want to continue in the business. So therefore, that's the best motivations that you can actually have, along with serious illnesses. And remember, just because someone's going through that particular position, you're not taking advantage of them. You're doing them a favor by taking the business off their hands, because you're taking that burden away from them. Because even though a business is a fantastic asset to own, it becomes a burden for people in certain circumstances.
The same thing comes in when we talk about desire, or the disparity of desire between a buyer and seller. At the end of the day, who wants to do the deal more tends to have the least amount of leverage in that sort of discussion. The old saying is, in order to get the best price, you've got to be able to walk away. Now, clearly, that works up until a point, and then sometimes you literally find yourself walking away with no deal. And we're going to talk a little bit about how to deal with that situation.
Right? You don't want to be a motivated buyer. I once was a motivated buyer for one transaction that I did, and it was the worst transaction that I did. Now, we didn't lose money, even though I consider that particular transaction to be losing money, but we're only making 10% ROI, which is a very, very small ROI when it comes down to alternative investments. And of course, acquisitions is an alternative investment.
But leverage or power is extremely important. And what I want to impress on you today is that leverage is often not absolute. Leverage is often perception. So just like beauty is in the eyes of the beholder, leverage is oftentimes in the eyes of the beholder as well. And both sides, both buyer and seller, can mold perceptions by how they run a process. And they could appear to be far stronger than they are. And so going into any sort of negotiation, you really need to think about perceptions, so guarding perceptions on your side, but really understanding what's going on the other side. And there's a few ways that you do that. One of the ways is through the use of information or knowledge. And this is an important attribute to a phenomenally skilled negotiator, is to be able to ferret out information on the other side that helps you appreciate leverage factors and conceal information on your side of the table that would potentially provide negative leverage to you.
So I did say that you try to extract as much information as possible from the seller. Also, at the same time, you need to conceal it from a buy side perspective. Just like Paul has mentioned, they need to do that from the sell side. From a buy side perspective, you can't let people know that you might be motivated to do the transaction. Now, remember, I said previously you should never be too motivated to do a transaction. That doesn't mean that you don't pursue transactions. What it means is that if there's a particular reason that you need to do it, let's say, for example, there's a business which hasn't had the growth factors that it normally has, and therefore, to achieve those growth targets, they need to do an M&A transaction. You need to conceal that fact and not tell them that, oh, to hit my targets for the next year, for my business to achieve the profitability that I need to achieve, I need to do this transaction. All you need to say, right, or you don't say anything regarding it. All you need to show the buyer is that you're participating with them in the process of their sale, and you are the person who can buy that business from them and participate from a buyer to their sale.
So concealing the fact that I absolutely have to sell my business, otherwise I'll go bankrupt, that's information that I need to conceal. Now,
And that's information that you definitely want to extract.
on the other side of the table, you might be trying to ferret out as much information as possible in order to understand how badly that acquirer needs to actually buy a business, right? Is it a defensive play? Do you have a business that if acquirer A were to buy, it would keep acquirer B out of that market? Therefore, acquirer A would be willing to pay more money for that? Is there an executive at the acquirer whose job is on the line pending this acquisition? So there's a variety of instances that can impact the disparity of desire between the two parties, and it's your job on the sell side to ferret that out. And that often doesn't happen through direct questioning.
So, like I said, from a buy side perspective, you need to conceal information which could give leverage to the seller on achieving a higher price or achieving more favorable terms. So even if, for example, you're trying to block out a competitor, like Paul mentioned, then you can't tell them that fact. You have to, again, say that I'm in here and participating in this sales process with you.
It's putting together the mosaic, right? It's a lot of reasoning through inference. It's spending a lot of time listening. It's spending a lot of time doing research before you even start the process. But the flow of information is an extremely important aspect of a negotiation process. And we're going to go further into that as we walk through a formal sell-side process. Another key aspect is judgment. And this is often where inexperienced negotiators really get their asses handed to themselves. You know, the old saying, you've got to know when to hold them and you've got to know when to fold them. You've got to know when to bluff. You've got to really understand what sort of leverage, actual leverage, exists on the other side, what sort of actual leverage exists on your side, attempt to mold the perception of the other side so that they believe that you have more leverage than they do. And then you have to use judgment as to your interactions between the parties. And a lot of this judgment really comes down to emotional detachment. You know, I've often said that the worst person to negotiate for me is me. I am too emotionally attached to my own assets, my own life, to actually be a good negotiator on my behalf. But I've learned this actually at a young age, because I've spent the majority of my life negotiating on behalf of others, that I know I'm not a good negotiator. So when I buy a car, I don't even show up personally at the showroom. I might go and test drive a car here or there, but when it's time to negotiate the purchase of that car, I send somebody in. Almost all of our big corporate negotiations get done by somebody else, not me. And there's a benefit, right, to putting the decision maker in the background. If I'm the decision maker, and in your case, if you own a business and you're the decision maker, it doesn't make great sense for you to be at the bargaining table. Now, having an agent bargain on your behalf and having some authority to make some concessions and score some wins, of course, is extremely helpful. But at the end of the day, stepping back from the bargaining table and remaining very emotionally detached and cool will allow you to operate under pressure. It will allow you to, the threats from the other side to basically just roll off your back, and you'll make far better decisions. And I guarantee if you remain emotionally detached and you allow somebody else to negotiate on your behalf, you'll likely have a much better outcome.
So using judgment in negotiations is extremely important, and I agree with one fact that you can't be emotional when you're in these transactions at all. However, I don't agree that the decision maker doesn't or shouldn't be at the table. I actually think that the decision maker should be at the table, but the decision maker should be able to detach emotion. Remember, when you're buying or even selling a business, any business transaction is an emotionless transaction. There's only one factor which is playing, is that how much benefit can be extracted from this transaction. Now, when we're saying benefit from a buy side perspective, it means benefit return on investment. From a sell side perspective, benefit means value that can be extracted and upfront, which means that on day one, how much cash on completion versus how much is being deferred over time. So it's really, really important that you do become completely emotionless and there's only one thing on your mind on the benefit that can be extracted. And if the decision maker is on the table, in my perspective, in my mind, that's actually a better way to extract as much value as from the transaction as possible, because the decision maker has all of the factors in front of them or all of the facts in front of them, and then they can make the best decisions to ensure that they can extract maximum value from that negotiation. But of course, there can't be any emotions attached to that.
In addition to exercising great judgment, another very, very important attribute to an outstanding negotiator is building credibility. And I don't think a lot of people think about this, particularly those that are not particularly skilled in negotiating prior to starting a process. When I was in private equity, I would go out and acquire businesses. Our firm would reach out to business owners. So if you're a business owner out there, you probably get emails, you get calls, you get buy-side brokers tracking you down saying, hey, I represent XYZ private equity firm. They're really interested in your space. They want to do a deal. We love your company. It seems great. Give us a call. Let's have a chat. So in my capacity at American Capital, which was the largest publicly traded buyout shop at the time, the firm would make a lot of reach outs. We would hear from sellers, and we would try to build relationships with them. And the first thing that we try to do is get investment from the potential seller, because the more time and effort somebody invests into a process, into a buyer, the more likely that they are to actually go through a deal. So we would try to get out in front of them quickly, take them out to dinner, wine them and dine them, and have them invest in a relationship. We were also trying to build credibility, that we would actually do what we say we would do.
So getting the other side to be invested in the process is very, very important. And it's one factor is that you will also be invested in the process. But again, if you remove the emotional side of the investment from your perspective, and the other side is emotionally involved and also financially involved, then it's more likely that the transaction moves in the favorable direction of you actually acquiring it. So having investment from the other side, both emotional and financial, is going to increase the chances of you achieving your acquisition.
But one of the things that I think was lost on a lot of the sellers who represented themselves in some of these transactions is it's really hard to negotiate with somebody if they don't believe what you said. And I'll give you an example of that. Let's say I work for the private equity firm. I'm talking to Jim. Jim's very interested in doing a deal with us. He wants to sell his mechanical contracting business. It's a $20 million firm. And we put an offer on the table for $20 million, but Jim wants 30. Jim might spend a lot of time having discussions with us. He might poo-poo the offer. Hey, I really wanted more than 20. I really wanted to get 30 to get this thing done. And then as we start to put the LOI on the table or the letter of intent, all of a sudden Jim out of nowhere says, well, hey, I've got another offer for 32 million. So unless you can match 32 million, I'm going with the other offer. Now, Jim may have been telling the truth, but more times than not, Jim was bluffing. And if Jim hadn't done the work to build up the credibility throughout the duration of the relationship, the easiest thing for us to do was call his bluff. Now, calling a bluff, and we're going to talk about this a little bit later in our discussion, is not always the right thing to do, because, the worst thing to do is he tells you, I want 32 million, otherwise I'm not doing a deal with you. And you were actually willing to pay the 32 million, but you said no way and called his bluff. And it turns out he was bluffing, and then somebody else came in the next day and bought it for 31 million. And those sorts of things happen. So there's some dynamics at play with regard to bluffing, which we're going to discuss. But, building up credibility is very important, because the more credible you are, in any sort of negotiation, there's going to be aspects that are extremely important to you and some that are not. You might be particularly concerned about price, but you don't care so much about a holdback term, for example. If you've built up that credibility and you're able to trade those things with the other side, and the other side actually believes you, you're going to have a much easier time getting what you want. And at the end of the day, exercising power is really getting others to do what you want.
So credibility is extremely important in anything that you do in life. But of course, in a transaction, the way that you can bring up credibility or build up credibility is by providing value to the seller. If, for example, you're able to provide value to the seller in some way, which is going to improve their business or even help them on sell side to achieve or to achieve something to move the process along on the M&A transaction that no one else is giving them, then you've built up credibility. I do this a lot. So we actually provide a lot of guidance to our sellers on how they need to or what they need to do to progress this transaction. And that really builds up credibility in the mind of the seller for us. So building up credibility is extremely important. Now, with regards to calling bluffs, me personally, I say that you should always call the bluff of a seller. And you might lose a deal, but the deals that do come back to you, you end up getting better terms and sometimes better pricing as well. And there's plenty more deals in the sea, plenty more fish in the sea. So you go out and you call bluffs and then you move on to the next deals. But even if you lose half of the transactions that you end up doing, or even if you lose 80% of the transactions that you end up doing, you will still be able to do multiple transactions because you are an active acquirer.
Now, as we discussed earlier, negotiation is a process. And one of the most important questions that I have to answer as an investment banker is what process are we going to use? You see, as a sell-side M&A advisor, I'm negotiating two things simultaneously. I'm negotiating process, so the rules and how the buyers have to work with us, as well as the substance, so the price and the terms of a transaction. There's somewhat of a smorgasbord of options that I could choose from a process perspective. But at the end of the day, in order to create a process that really maximizes the value and the price for my client, I need to form a process that incorporates everything we just discussed, right? Number one, a process that allows us to ascertain information about every buyer. What are the buyer's motivations? What are the buyer's incentives? Are they the level of desire the buyer has in order to do the deal? Is there any buyer that has a necessity to do a deal, which is...
All of these, by the way, motives, incentives, desire, and necessity, you need to hide as much as possible of that. All you need to tell the seller is that we're acquiring businesses to grow. That's all you need to tell the seller. Because if you get into, okay, motives is to grow. Incentives is, of course, to achieve a bigger business. But desire should go back to growth and to have a bigger business. There should be no necessity. Even if you have a necessity, that should never, ever come to the transaction or to come to the conversation. And any desire should be linked back to growing a bigger business and achieving a bigger business.
Extremely rare, but it can't happen. So ferreting out information. Also, my process needs to be able to protect information and conceal information on my side. So I've got to be able to conceal my client's desires, his or her necessities, how badly they want to do a deal. If there's any particular problems, needs to be concealed.
Right. From a buyer's perspective, we want to find out all four of these. And again, a good buyer is going to understand their desires and really probe out their necessities and their problems. So once you understand what their problems are, then you'll be able to use that to your advantage and peg it back to the necessities and get them to give you a better price and better terms and actually achieve a transaction.
Number two, the process has to provide maximum leverage through optionality, meaning I have to have enough competitors in here to drive up the price, right? I have to be running my own auction. I have to have a lot of buyers bidding against each other to help me raise the price. And so in the process that I need to create, although I will be doing some cross-table negotiation, right? I will be negotiating directly with a buyer. I also want buyers to be doing same side of the table negotiations. So if you imagine a handful of buyers sitting on the other side of the table, I want them negotiating amongst themselves through competition to bid up the price. So the process has to ferret out information, conceal information. It has to introduce the concept of competition, which gives me leverage.
Right. So there's normally more competition when you get into mid-market sized businesses. In small businesses, there's very little competition which exists in that marketplace. So any business which is doing less than 5 million in revenue has very, very little competition. So you as a buyer will normally have all of the power on your side if you're going to acquire businesses which are doing less than 5 million in revenue, particularly when you're buying businesses which are less than 2 million in revenue. Now, I don't really recommend that. The minimum that I say that you should go to acquire is a minimum business doing 1 million in revenue, and even that should be one of your first or second transaction. Thereafter, you should go as big as you can. In fact, for your first transaction, you should go as big as possible anyway. Now, what about those businesses in which are 5 million to 20 million in revenue? Now, the competition that you would normally have from other buyers on a business, or when you're trying to acquire businesses doing from 5 million to 20 million in revenue, are going to be other businesses which are normally about your size. So you might be a small business right now or a lower mid-cap business going to acquire bolt-on transactions. The competition is going to be from similar businesses like yourself, and they would have similar buying power as you do too. So the only difference would be is if they have private equity backing or some VC backing if it's tech, for example. Generally speaking, they don't, and they're going to acquire so they can get bigger. So always remember that your competitors at the 5 to 20 million range are going to be very, very similar to the way you're same buying power. Now, when you get to businesses which are 20 million plus, that's when private equity and large strategics normally get involved. In fact, strategics can get involved in smaller businesses as well, but private equity doesn't really look at businesses which are doing less than 20 million revenue, because that's 20 million revenue. Let's say, for example, an average profit margin is 10%. That's 2 million in profit, 2 million in EBITDA. And private equity only just starts getting interested at sort of 2, 3, 5 million in EBITDA. So, that's when you need to start thinking about backing yourself. So you might have buying power as a business, as an investor yourself, but also can you get other investors? Can you get other private equity to also back you? You will be able to compete with other people if you are competing. The majority of the time, you won't be competing if you're doing any transactions which are less than 5 million in revenue, and you'll be doing bolt-on acquisitions. So let's say, for example, you're a mid-sized business and you're a platform business, you're going to do bolt-on acquisitions, you have very, very little competition on your side. And of course, so even if you're mid-market and you're going to buy other mid-market companies, there will be no competition. There'll be very, very little competition if you're buying off-market deals.
I also want to be able to use time, right? So in setting the process rules, I will be setting deadlines throughout where all buyers will have to act simultaneously. There's bid deadlines where bids have to be submitted at a certain time. I need to be able to control that. And that allows me to set a deadline that impacts the other side simultaneously, but does not impact me, right? So I'm using time. I'm also using time for other advantages. I'm using time from an investment perspective. I've got one unique asset, my client's business. I've got 25 buyers. I want each of those 25 buyers to go through a process to continue to invest time, money, and resources, as well as time into the relationship with my client, the seller. And the seller actually is doing that simultaneously with 25 buyers. So I'm able to create a tremendous amount of investment over a period of months with the buyers, which will positively impact the leverage that I have in the situation. So I'm
Never be involved in a bidding process with 25 other buyers. It's just not worth it. There's plenty more businesses out there, and I advise you from a buyer perspective, you just exit that process. Let other buyers bid on the businesses and deal with this situation. Generally speaking, from a buyer perspective, there's plenty more businesses out there you can go and purchase from a much easier perspective.
using time, I'm using information, I'm using leverage through competition. And I'm also strengthening my credibility from the very onset. Let's say that you own a business and you've been talking to one particular acquirer for a few weeks now. You've gone out to dinner, he's come to your office, you've started to talk some numbers, you've shared some numbers, He comes back and says, I want to buy your business for $20 million, and you want to sell it for $30 million. If this goes on for some weeks and then at the very last minute, you tell him, hey, I really want more money for my business. I'm going to go out and introduce competition into this process. I'm going to go out and talk to some other acquirers. This could do one of a couple of things. Number one, the buyer could automatically get his act in gear because he doesn't want competition and he could raise his price. Or two, and what's often very common, is he'll get frustrated. He'll feel like you had built a rapport with him, that you wanted to sell your business to him, and then all of a sudden now, because you weren't getting your way, you were going to introduce some competition, which is adverse, of course, to his position. And so that frustrates the relationship, and you lose some credibility. And I'm a firm believer that if you start from the onset, introducing all the leverage factors and molding the perception of the other side, you can maintain credibility throughout the process. And what I mean by that is by bringing competition in right off the bat, where all of the buyers know that there's a variety of buyers here. This is a formal sell-side process. They will be competing against other buyers in order to have the opportunity to buy this asset. You're not switching anything up on them last minute, and you can maintain that credibility throughout the process. So these key components go into how we can construct a formal sell-side process that will maximize the value of your business. And here's how this works in practice.
Now, when it comes down to a situation where you're talking exclusively to a seller and they then say that they want to introduce competition into the process, Paul mentioned two things that normally end up happening. Is correct here. Is that either the buyer raises their price and says, right, that's fine, I'm willing to pay the price that, or willing to pay a higher price than we've been talking about. And the second thing, by the way, you would always become frustrated as a buyer if the seller says that and you've been dealing exclusively and you think everything's moving along. You will become frustrated. And remember, you need to try to remove emotion as much as possible. But initial frustration is a human emotion which no one can really get rid of. It's just about reducing the time of that frustration. So if you are a buyer and you're speaking to a particular business, and why would you want to raise the price? Sometimes it's worth paying a premium for a business if that business is unique in its positioning in the marketplace or its offering, and it's worth paying a little bit more, a bit of a premium, to ensure that you are the one that ends up with that particular business. We were ready to pay a premium for a business in one of the transactions that we did. Now, thankfully, we didn't have to pay a premium. In fact, we got a very, very good deal. But when we came across this business, it had a unique offering in the marketplace, or should I say, it had a particular position. It wasn't a unique offering, it had a particular position in the marketplace in which we were like, okay, if this gets to a certain, past our normal structure or the normal price, the valuations that we would pay, we would be willing to go past further by X amount. Now, luckily, we didn't. But I'm just trying to say that sometimes it's worth paying a premium for a business if, for example, there's something about that business which is unique. But generally speaking, if, for example, like I mentioned before, they want to introduce competition and you're not willing to pay the premium because the business is not worth paying that premium, call their bluff and say, right, that's fine. Go out and put it in the marketplace. Go and deal with the people. And remember, you're wowing people with other factors than price. And if you can't achieve the business sale that you think that you want to achieve right now, then come back to us. And like I said, some of them don't come back. In fact, majority of them don't come back. But the ones that do come back, you will have favorable price terms and favorable terms, meaning the structure of the deal that you can achieve in that transaction.
When a seller comes into me and says, hey, Paul, I've got a $20 million revenue lawn care business, and I want to sell this company. I would like to sell it within the next year. Can you take a look at it? And one of the first things we do at POTOMAC is we'll execute a non-disclosure agreement. We'll say, sure, send us your financial statements. We will ask questions. We'll spend some time with the potential client on the phone. We don't even ask for an engagement off the bat. We'll just sign a non-disclosure agreement. We'll do some upfront work, and we'll take a look at the business, and we'll determine what we think it's potentially worth. and we'll have conversations with the seller. And that, of course, is part of the whole information process. And what I mean by that is we have access, obviously, due to all the transactions that we do and all the data that we have. We know what all the comparable acquisition statistics are. So we know what other lawn care businesses around the country trade for. And we can use some of that to inform our valuation decision with regard to that particular client. But, that's not end all be all. I think we should always keep in mind that comparable acquisition statistics can be helpful, but there are a lot of instances where, those tend to just be averages, and there tends to be a lot of outliers, some really on the high end, some on the low end. So an advisor that has great experience and judgment is going to be able to help you kind of understand where you'll fit. So the first part is beginning to ferret out information. What do the comps look like? What's the valuation and market conditions in the current market? What are the likely buyers, right? Is this business in an area where you might have some defensive acquisition activity taking place? Is this where private equity firms are acquiring platforms or doing add-on acquisitions? There's a lot that goes into this, but by using all this information, you're able to determine and set realistic expectations. So the first part of any sort of sell-side process is understanding what realistic expectations are. What are you likely to sell this business for? And, before we ever go to market with a client, I like to be able to see eye to eye. And over the last 10 years, as we've seen valuations continue to ramp up, we've lived in an era of asset price inflation, right? Valuations, look at the stock market even today, it's still pretty close to an all-time high. So valuations have continued to increase. This has benefited the owners of businesses and financial assets. And oftentimes, our realistic expectations when we go out into the market tend to be conservative, really. We're surprised quite often to the upside. And I will tell you, back in 2009 and 2010, we were very often surprised to the downside. And quite frankly, we were surprised so much a lot of the deals didn't happen, right? Just talking the other day, I remember in 2009, just a very small number of deals even took place. But in this particular market, setting realistic expectations. So let's just use some random examples here. You've got a business and you say, you know what? I'm sitting down with my advisor. We're taking a look at the comps. We're running a DCF. We're looking at a transaction model. We're tweaking things. We're going to try to go to market within the next 12 months. There's a variety of little tweaks we can make to the business, but for all intents and purposes, within a year out, there's not a tremendous amount you can do. But now we know that this business will likely sell for $50 million, right? So this is kind of like the meaty part of the bell curve. This is likely where it will happen. Now, if you get super lucky and a new acquirer comes into the market or a private equity firm decides they've got to pay to play and that's a perfect platform, could you get 55? Could you get 60? Could you get 75? Yes, I've seen it happen just this year. We went out to market with a company that we thought was going to get $50 million, and a private equity firm came in and paid $75 million for it. So those things do happen.
With regards to the pricing that a acquirer is looking to pay, you remember I said there's 4 approaches to valuations. You want to achieve intrinsic value. It's very rare to achieve intrinsic value. In fact, I've never achieved intrinsic value on a particular transaction, but we paid fair market value. So in Paul's example right now, he's saying that we're likely to achieve 50 million for this transaction. That's probably based on fair market value. And of course, private equity came in and they paid strategic value for the business, which is 75 million. So 25 million premium, which is a 50% premium. It's fantastic for the seller. Really, really happy for whoever that person was. Of course, they achieved a massive premium on their business. So on their exit. So you need to come in and you need to understand what fair market value is and try to avoid getting to anywhere close to strategic value.
But setting realistic expectations will kind of help you on the onset. One of the things that I have to fight against personally, and I've had to do it for over 20 years, when you're involved in a lot of transactions and you're seeing, 50 pest control or 50 lawn care deals per year, and you're seeing that all of these purchase price multiples tend to cluster in a particular area, it's very easy to look at the subject company and say, okay, based on the comps, this is what this thing is selling for. This is going to sell for $50 million. And you tend to lose the high expectations and aspirations that you would otherwise have. And I always talk to my team about, It's important for us to be forthright with the client. Like, hey, this is the reasonable expectation, $50 million. But when we go out to market, we're not shooting for $50 million. We're shooting for 80, right? We're shooting for a very aspirational price. And one of my earlier talks, I always talked about negotiate like a child. When kids want something,
Right. When it comes down to, it's the same for buy side, by the way. So what Paul's talking about is from sell side, they want to try to achieve the highest price, even though they've been achieving transactions at a particular price, at a particular multiple, a particular valuation. When you're going out and you're doing multiple transactions, there's something that we talk about a lot with my board of directors, and a particular one director, he's always highlighting this point. He said, we've done transactions between these valuations, but let's not get lazy and let's try to always achieve the best deal that we can for the next transaction that we're looking at. So from a buy side perspective, even though you may be paying a particular multiple for transactions, always try to achieve, for example, intrinsic value or less than intrinsic value for a business. And that will ensure that you're going out and you're doing the best job for yourself. Because, of course, when you're going out to do transactions, you're trying to achieve high ROI, which is going to be massively in your favor.
they don't take no for an answer. Like, no is just an opening bargaining position, right? A kid wants ice cream, goes to his mom, and his mom says, no, you're about to eat dinner, no ice cream. Fine, I'll accept that no. That wasn't really a no. I'm going to go to my dad. Dad, can I have the ice cream? They begin to divide and conquer, and they just have at it. And they yap until somebody gives in, and they ultimately get it. So having high aspirations, right? Having the aspirations of a child, like I want to go to the moon, I'm going to be an astronaut, is very important for M&A advisors. And it's unfortunate because I do see it quite often that M&A advisors will want to just get a deal done, and it's safe to do a deal in range, right? That's where market is. Let's get it done. Chop, 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 churn and burn. But here at my firm at POTOMAC, we always focus on having extremely high aspirations, which, by the way, is sometimes difficult working with a client because we tell the client it's likely $50 million, but we're aspirational that we can hit 80. Now, of course, the second the word 80 comes out of my mouth, the client anchors to 80 and it's an $80 million business. But I would rather take that risk and have them anchor high than be set on the 50, because the higher our aspirations, the greater the chance that we're going to exceed that. So again, it's very important to give a realistic range to the client, but it's also very important to come up with the aspirational range, which I typically tell clients, like, listen, if lightning strikes twice, if everything goes in your favor, if a buyer comes in and absolutely needs to buy this business in this particular location, the business has the right capabilities, all stars aligned, you have a possibility of getting all the way here. Now, chances are of that happening are slim, but it's a possibility. Listen, I know clients never come in with a $20 million business and say, yeah, you know what? I just want $10 million for my business. I know clients always want more than their business will likely sell for in that reasonable range. But again, setting aspirations is important because in the game of negotiation, so much of this is psychological, right? So much of this is perception. So aiming for the stars, it's the only way to put you in a position to actually be able to do that. So you need to do that with each client.
Right. Aspirational prices. Sellers always think that their business is worth more than it actually is. The truth is that most business owners don't know anything about valuations of a business. And most of the time it works against you as a business buyer because their aspirations are so high and they're completely unrealistic as to what they can achieve for their business. But sometimes it works in your favor. In fact, just recently I was talking to a business owner who did not know at all what their business was worth. And I could have actually said anything that I wanted. So that particular owner, I'm helping them from a sell side perspective. So I told them what their fair market value is and also what their negotiated value could be. Their business is a little bit too small to achieve any real strategic value, but they would definitely be able to achieve more than fair market value because they are a decent sized small business. They're around about the mid size of mid upper size of a small business, and in that particular industry, that is a decent size. So business owners in that particular case, they thought that their business was worth less, that than it actually was. But I told them what it's actually worth. And sometimes as a buyer, you also get that situation. It's not common, but occasionally it does happen. And if it does happen and it's an off-market deal, then you should jump on it as much as you can or as fast as you can as a business acquirer.
So now that we've done the research, right, we've taken a look at the business, we've gotten a sense for a realistic range, we have an aspirational number that we want to hit. Now it's time to start to craft the process. We've got to put together a formal game plan. And there's a variety of ways to sell a business, and they're on a spectrum. On the one end of the spectrum, we have direct negotiation between one buyer and one seller, which is largely the worst way to ever sell a business.
And this is largely the best way for us to buy a business. One buyer meaning us, and one seller meaning them. So that's the best way that we want to achieve. And like I said, for small businesses, anything sort of 10 million, well, majority of the time, 5 million and below, there's very little competition. So in most cases, it will be the situation. 5 million to 20 million, there could be other competitors there, but you can wow them very easily with other factors. 20 million and above, that's when competition starts setting in, and you can wow them with other factors, but also if you have someone who's backing you financially, then it's very, very good.
It usually ends in failure, low prices, and disappointment. On the other end of the spectrum, we have what's called a controlled auction process. It is a very formal, rules-based process, and you have this spectrum. The majority of middle market businesses, though, and when the process is run correctly, are typically sold somewhere in the middle, which I refer to as a quasi-auction or a modified auction. Now, I'm not going to go into auction theory today. I did a speech earlier this year at the AZPPO conference. We'll put a link in the comments. You could take a look at that if you're interested in understanding more about the difference between a controlled auction, a modified auction, and how well that works. For our purposes today, we're going to focus right in the middle at the modified auction, and that is the best process typically for middle market businesses. And if your investment banker is worth his salt, this is the process that he's going to construct. So we've got realistic expectations. We have an aspirational price. Now it's time to look at the acquisition universe. Again, leverage. We're going to think about leverage and power, and the best way that we can get leverage is competition. So prior to going out to the market, as we're formulating our game plan, we're going to do some research on the acquisition universe. And we're going to look at all of the publicly traded national companies that are in your industry. Right? If you own a lawn care business, we're going to look at the national players. We're going to look at the private equity-backed players. We're going to look at some of the regional players. And depending upon how big your business is, we're not going to call local competitors. Oftentimes it doesn't make sense. We're going to be as broad as we possibly can with finding the acquirers to put into the acquisition universe. But we're not going to boil the ocean. We're not just throwing things up against the wall. I know a lot of times business brokers will sell businesses through listings, right? And they'll put a listing online, which to me was always somewhat asinine. I mean, it's almost, in some ways, it's like selling an antique Stradivarius violin on Craigslist. It just never really made sense to me, and the facts speak for themselves. The processes usually don't yield the seller nearly as much as they should if you actually go out hunting as opposed to just fishing and throwing your bait in the water to see what bites. No, you've got to be a hunter in this particular case. So you've got to get very sophisticated about the acquisition universe. So go out and figure out what private equity firms want to be in this market, what private equity firms are in this market, what national players are in this market. And now you start to build an acquisition universe.
So from a buyer's perspective, you want to build an acquisition universe as well. And it's about going out there, like I said, being a hunter, not a fisher, and going out and hunting for particular acquisition targets which are off market. And sometimes, for example, you can be a fisher and actually do very well as well. So predominantly in my market, I am a fisher more than a hunter, but I also hunt for deals as well. And depending on what industry you're in, you might need to gravitate more towards a hunter than a fisher and build the acquisition universe accordingly.
Acquirers. And as you start to think about the list of acquirers and you're working on fine-tuning the business and you're putting together what will oftentimes referred to as a SIM, a confidential information memo. Sometimes it's called an offering memo. Sometimes it's called a book. I mean, there's a variety of terms for it, but effectively what you're doing is you're taking the financial statements, you're summarizing the business, the operations, the employees, the history, so on and so forth. And you have a memo that might be 30 or 40 pages long. And it's this memo that every acquirer is going to have an opportunity to take a look at, and they'll be required to make their initial bid based on these materials. So we figure out who the acquirers are, and then we think about, as we're drafting the SIM, now we set up a timeline. And the timeline is very important because, again, one of the most important things that you can do on the sell side is control process. So as a sell side advisor, you are establishing the timeline when the non-disclosure agreements go out to buyers. So every buyer will sign a non-disclosure agreement. And if your advisor is doing his job, the non-disclosure agreement will have certain non-solicitation terms in there so that buyers can't get your materials, figure out who your employees are, and say, oh, man, this guy looks great. Let's go out and see if we can hire him. No, you want non-solicitation of employees and customers built right into that non-disclosure agreement. But the non-disclosure agreement will go out first. Then the sell-side materials, the SIM, the acquirers will have an opportunity to review that, submit some questions, and then the process carries on from there. And what we've done is, again, using these key ingredients and dynamics from negotiation, we've begun to build leverage, right? We brought in optionality from the get-go. We're maintaining our credibility because it's a formal sell-side process, and all the buyers know that a variety of different acquirers will be looking at this. We are controlling this process because we're setting the timeline. And what will typically happen in a controlled process like this is the materials go out the door. The acquirers might have 2 weeks, they might have a month, it depends. And this varies, and it varies, quite frankly, based on seasonality, right? Like, so sometimes if you were to go to market in late fall, well, you know Thanksgiving's coming up, you know Christmas is coming up, you can't really push acquirers to move quickly because people take a lot of vacations. Same thing in summer. Like July is a horrible time to put acquirers under, a 2-week deadline. So you have to be cognizant of seasonality, but it could be anywhere from a couple of weeks to a month. And at that point in time, what we tend to ask for is we'll send out a process letter along with the SIM that'll say, on Wednesday the 15th at 5 p.m., your proposal for the acquisition of XYZ company is due. This proposal should include, and we want to see a variety of different things. We want to see price, and we'd like to see it in an absolute term as opposed to a range. I'd rather see I'd rather see it say, we're willing to pay $35 million versus we're willing to pay 30 to 35.
So here, when you're at this stage, so the stage he's currently talking about is you signed your NDA, and then you've received initial materials. Now, sometimes you might receive materials like a teaser document, which is prior to an NDA, which gives very little specific details about the business, but it shows for example, revenue and profitability. And he said that he wants people to submit bids in absolute terms, meaning exactly what they're going to pay. From buy side perspective, at this stage, it's too early to determine what formal or an absolute bid is going to be. So from our perspective, as a buyer side perspective, giving a range at this stage is what you want to achieve. Now, I just want to highlight one thing. What Paul is going through here, what POTOMAC is doing, is normally for larger size businesses. So businesses which are doing around about 20 million and above, normally about 50 million and above. If you are buying a business which is doing 20 million or below, or even 50 million below in some circumstances, then you will not be subject to this formal process, which Paul is going to be talking about in the rest of this bidding process. Okay, so you will essentially create your own process, and you will submit bids according to your own timeline in majority of the cases if you're buying businesses which are in the lower mid-cap market up to, for example, small businesses. So just take that as a consideration when you're doing transactions which are anything from $1 million up to 20 million, and in some cases up to 50 million in revenue.
We're willing to pay $35 million versus we're willing to pay 30 to 35. I want to know what the structure of the deal is. Is there seller notes? Are there any sort of holdbacks? Are there any earnouts or contingencies? What does that look like? A statement of intent. What do you intend to do with the owner?
It would be way too early to understand what kind of holdbacks and what kind of deferred elements would be in there, because you don't know anything about the business. So the fact that people acquirers, or in his experience, and Potomac's experience is quite unique in the sense that from the little bit of research that I've done after watching this is that he is doing particular industries and he controls a lot of the market, so he's able to do that for those markets. If you're in a market in which particular brokers are controlling that industry, then you will be subject to terms like this. If you're in a market where brokers are not controlling the industry, and when I mean controlling the industry, in Potomac's term, I think he said something like he controls about 80% of the pest control market globally. He's in a very, very strong and unique position there. And if you are in a market where the broker controls something similar like that, then you'll probably need to submit to this process. But generally speaking, you will not submit to this kind of process, and it'll be too early to understand what kind of deferred elements and holdbacks and other conditions you want to put to the deal structure.
Or what do you intend to do with the employees? Financing. Like, do you actually have the money to do this deal, or do you have to borrow it? So there's a handful of components that we request to be put into the proposal, but that initial proposal is typically referred to as an indication of interest. It's oftentimes a document that's 1 to 3 pages. It's non-binding. It's a friendly document.
So our indication of interest is normally just done by email. You don't need to put it into a document. We've put it in document a couple of times. I've had clients that have bigger businesses that want to go and acquire, and we've asked them to do, or they've been asked to do, an indication of interest document. That's perfectly fine as well. It's very similar to an LOI, which Paul will be talking about in a minute, but it's a little bit of a watered down version, as Paul is going through now.
Letter that says, hey, we loved the opportunity of reviewing the materials on your client. We're super excited about the space. We think it's a great business. We'd be willing to pay X for it. Here's how we'd structure it. We have cash on hand. You could just write a check, get the deal done. Here's what we're going to do with the team, so on and so forth. Would love the opportunity to meet with management. Now, those proposals are all due on the same day, and there's a reason for that. It is very, very difficult to review proposals serially. You always want to look at them in parallel. It's the ability to compare and contrast offers, which allows clients and their advisors to determine which proposals are better. And this process, by doing it this way, keeps the seller away from the age-old problem of revealing information. And so I want to talk about this. So we're using this deadline, this time here, to build leverage. But this deadline also allows us to conceal things. And here's what it does. If you go out to market, let's say that you're selling your business and you talk to 3 different buyers, and you're having some conversations, and each buyer says, hey, give me some financial information, I want to take a look at it, and you hear from all buyers, and all 3 of them want to do some sort of a deal, and they want to put together proposals or letters of intent. If you don't have a deadline, now you're waiting, right? You're sitting there, you're waiting. And so let's say, Jim at acquirer A shows up and says, hey, Paul, here's my offer. I'm super excited about buying your business. And I look at it and I'm like, okay, it's a $10 million offer. Seems great. I wish I could get more, but maybe it's acceptable. I'm not sure. It depends on what the other 2 are going to do. Now I'm waiting for the other 2. And Jim happened to put at the bottom of the offer that, hey, Paul, you've got 5 days to consider this. You either accept it or reject it. And if you accept it, please sign and return it to me. So now I've got an exploding offer. So what do I do? Well, I didn't set a deadline, and now I'm calling Dennis and Ryan. Dennis and Ryan are the individuals at the other acquirers, and I call Dennis up and I say, hey, Dennis, you said you're going to put out an offer. I'm just curious, what you're going to do. And Dennis starts asking questions like, hey, I didn't think you were in a rush and you want to try to build competition for yourself. So, hey, I got an offer from another party. And Dennis said, well, how much was it for? And you're like, I'm a little uncomfortable saying that. And you guys both go back and forth. Well, you've done one good thing, which you've introduced competition. But now you've put yourself in a bad position, because when we talk about disparity of desire, you are actually making the phone call, right? You're chasing the girl now. And so you're calling Dennis. You're going to be calling Ryan as well. I mean, when you start asking for their offers, a lot of times it makes them start to ask a lot of questions and really try to put you in a position, really try to understand the position that you might be in. And now you could say, hey, I am interested in moving this forward quickly because I have another offer that's going to explode. But if you haven't built the requisite amount of credibility, why should they believe you? Like, you could be bluffing about the other offer. You could actually be desperate to sell. So now you find yourself in somewhat of a pickle. And I know from absolute objective fact from historically doing deals. Every single time when I was in private equity and every time a seller called me looking for an offer or seeking feedback, I knew I had somebody that had more desire to do a deal than I did, right? And so that definitely plays in the calculations as to what I'm willing to pay, and it absolutely should. You've put yourself in a bad position. You haven't said I want to sell, but your actions are speaking louder than words. And sophisticated buyers are paying attention to this. So
This is actually very important. So I know it's on fast speed, but he's saying that if, for example, sellers are bluffing, and then you can pick up on that fact as a sophisticated buyer, then that you can use that to your advantage. And without a doubt, that's exactly what you need to do. When you're a sophisticated buyer, when you are able to pick up on cues from the seller that they are under pressure in some sort of way, then you can use that to your advantage, whether that's price or terms. Both ways are correct, by the way. Both ways are good for you as a buyer. So, for example, I say sometimes I'm willing to pay a higher price as long as the terms are more favorable, right? And if the terms are not favorable, then I'm not willing to pay that high price. And if you can pick up on the vulnerabilities of a seller, then you are able to use those vulnerabilities to your advantage to get either better price or get better terms, which work in your favor.
how do you avoid that? At the very beginning of the process, you set up arbitrary deadlines. You want to play? Here's when you got to pay. You've got to tender your offer on such and such a time, and now you're not calling these guys. And if they blow through the deadline, and sometimes as an advisor, I'm flexible. If people call me up and say, "Hey, we really want to do this deal, but boss man's on vacation and I can't get an approval on Monday," no problem. Like, deadlines are made to be broken sometimes, but at the end of the day, it puts me in a position of power. It puts you, the client, in a position of power because now we're not we're not revealing anything, right? We set this up from the get-go. This is what the deadlines do. No one's chasing anyone. Buyers come to us. So the first deadline is for the indication of interest. And that indication of interest really kind of establishes, we say it sets markers, right? We've got, if we're lucky, let's say that, in a typical process that we're doing now in the resi and commercial services space, we'll usually go out to somewhere between 30 and 40 private equity firms. And then somewhere between 5 and 10 actual strategic acquirers. And those might be national players in a space. They might be large regionals. They might be private equity-backed platforms. But in any given deal, somewhere between 30 and 50 NDAs go out, and the majority of those get signed. And then somewhere between 30 and 50 information memos go out to those buyers, and they're invited to provide us a proposal by the deadline in the form of an IOI. We get the IOI, and now we're able to lay them side by side. If we're lucky, let's say 50 go out and we get 10 IOIs. I would say that's a really good day, right? We've got 10 IOIs, you've got 10 firms. Now, I know that right off the bat, probably half of those, 5 of those are some 23-year-old kid working in an office just writing IOIs, and the boss looks at it and says, "Yeah, throw it in, let's see what we can do." But we've got 10 different things to look at. And from there, the sell side process is really a private, it's a concealed bid private auction is really what it is. And so we are going through iterative bid phases. And so we start at the IOI. It's really what it is. And so we are going through iterative bid phases. And so we start at the IOI. And then the next phase would be, okay, in order for an acquirer to really get a good sense of whether or not they want to do a deal, they have to meet with at least the owner and likely the management team. And it depends upon the size of the company. But for now,
very, very important that you're able to meet the owner in person, or at least video call these days, post pandemic. But generally, I like to visit the businesses as well. And you need to meet the management team. The management team you need to meet in person because the owner is going to depart. But the management team, you want to retain them to ensure that, majority of the time you're going to be an owner investor, or even if you're going to an owner operator because you're strategic and you're buying other businesses, then you need to ensure that there's management in place who can continue to run the sites. That business is successful due to the team that's currently running it, and partly for the owner as well, of course. But you need to meet with the management team to ensure that they are bought into the transaction, they're bought into the business, and they're willing to stay.
for our purposes today, let's say they're going to meet with a small group of the management team of your business, 3 people. In a negotiation, there are concessions and there's reciprocity. There's always quid pro quo. So, acquirers, you have tendered an IOI. You want a meeting with a management team. You have to do something for me. There's a quid pro quo. You have the ability to buy the option to sit down with management, but it's going to cost you. So, I've got your IOI. This is not going to cut it. This deal's not going to transact at this price. You need to revise your bid forward. Raise your price, change your terms. Here's some of the things we don't like in your IOI. And if you're willing to do that, we'll know you're a little bit more serious and we're going to be willing to sit down with you. And so you cause all buyers to purchase the ability to sit down with management team. There's no free ride in this. They revise their offer. They start showing us what we want. Now they can sit down with management. So in that particular case, we get the IOIs and we might say the first bid is due on, June 1st, right? You got 10 days, revise your bid, or you have 5 days, what have you. And depending upon the time of year, we would change the structure here. But let's say you got 5 days. And now in that particular case, we might lose 3, right? We might get 7 revised bids. 3 might say, hey, listen, I'm not willing to pay more than that. So now we've got 7.
So remember, from the smaller businesses, and I'm going to utilize that as lower mid cap and below, you would normally not be subject to this process. This process does not exist in that marketplace. And meeting the management team and meeting the seller, of course, is not going to be a condition by buying into that particular, or to, you need to pay to play, as he's saying. Of course, if you are dealing with a sophisticated broker and you're dealing with an on-market deal, then sometimes you may need to be subject to that process. Then you do need to revise your offer to be able to go to the next stage. Now, he raised a very, very important fact about quid pro quo, about giving concessions and also, also giving things or taking things as well. Whenever you're in a negotiation, if you're going to give something, you should take something as well. That's what quid pro quo means. So always ensure that when you're doing a negotiation, you give, but you also take at the same time. And ideally, what you give is smaller than what you're taking. So you should always take something which is larger and give something which is smaller.
And we take a look at that, and then we as advisors have some decisions to make, because although at times price and terms may all cluster and it may be very, very close, but at other times there's wide dispersions, right? We might have a $15 million offer, a $19 million offer, a $24 million offer, different sorts of structures. So we have to determine who we're going to let to see management. And, old standby position is start with the lowest. If you've got a $24 million offer and you've got a $17 million offer, you might go to the $17 million guy and say, hey, listen, you're really off the mark on this. And while we appreciate doing business with you, it makes sense to have a meeting when you're the lowest offer we have at hand. So if you're serious, I would in good faith revise your offer forward, and we'll see if it makes sense for you to have a sit down with management. We might do the lowest offer and the second lowest. Hell, we might do that with all of them. I'm not quite sure yet, and kind of get that feel as we go through the process. But if we do that, and let's say another one falls out and a few revise their bid forward, now they have the management meeting. And so they sit down with management. And of course, after the management meeting, ideally, what's happening here is this. Management is building a relationship with each buyer. So they are investing time and energy into each buyer, and the buyer is investing time, resources into the relationship. We want investment on both sides. The sellers, I know that this is very cliche and probably goes without saying, but I see this as such a massive problem. I can't not say this. And if you're an M&A advisor out there, you're going to laugh at this, because it boggles my mind how very sophisticated, very kind, gentle individuals who have built great businesses could actually sit down with buyers and be total dicks and be condescending pricks. Like, if you are a seller, every time you sit down with a buyer in a controlled environment, in a management meeting, you should only have eyes for that buyer. You should be smiling, pouring coffee. You should fight all desire to run your mouth, because you get far more information from listening than you do from talking.
Very, very important point that Paul has just raised is that you need to really be nice to, even from a buyer's perspective, to the seller. So you need to almost wine them and dine them a little bit, and to ensure that they look favorably to you and your team. If you can create that with the seller, then they're going to look at you favorably, and they're going to start warming towards you to ensure that you become their favored option, even if there are other people which are in the scene. And again, normally there won't be other people, because you'll be the only person that is looking at their business, especially in certain industries.
So be sweet, be kind, take notes. Have a notepad. Take notes as buyers talk. Listen. Work with your advisor and make sure you've got a full list of questions. Do your research on that private equity fund. Do your research on the acquirer. Do your research on the individuals. Have sophisticated, well thought out questions in order to ascertain information because
Right. From a buy perspective, the questions that you need is more around the business that you're buying. If you, and like he said, if you can listen more and get them to talk more, that's better. I know he's saying the opposite way, we're saying the opposite way. People like to talk about themselves, and business owners love to talk about their business. So if you can get them to talk about their business and you take notes and then you just compliment them about the great job that they've done over the years to build this fantastic asset, this fantastic business, then you are going to be in their good books and they're going to warm towards you to ensure that you might be their favored option and you would be the best person to buy the business.
again, this information, this is your opportunity to get a ton of information that you will use and we will use as we move through the process and try to ratchet up the price. So again, be sweet, be kind, be very humble. Listen, be emotionally detached. Don't take anything too serious. Have fun. Have fun. Smile and have fun. This is what you need to do. I mean, I say this to every single client, and just like I say it, and sometimes they go in there and do the exact opposite. So I guess now I am officially putting it on public record. This is what I say. Do it. So you go in, you sit down, and a management meeting is basically a situation where the acquirer will walk in with the SIM. So they've studied the SIM and they've got a variety of questions, and they may have sent over some questions in advance that we'd be prepared for. But the acquirer sits down and says, "Hey, Rob, love your business, super excited about it. I've got questions about your president. I've got questions about your HR process. I got questions about your operations. I've got some random questions on the financial statements. And it looks like you guys had some non-cash charges last year. What happened there? Oh, we did some rebranding." So you tend to have a relatively informal, and sometimes these are more formal in structure, but it's a relatively informal meeting where you're answering a lot of questions. You might do a brief presentation on the history and the overview of the company and talk about some of the competitive advantages you have. But it should be a relaxed and friendly and humorous situation. And then you'll have dinner. Again, your goal is number one.
One thing that Paul said, and is very important, don't be emotional in the conversation. Remember, it's a business conversation. Yes, you're being nice, you're trying to attract the attention of the seller, but you need to be, it's a business transaction. Have your business mind, take emotions out of it. Even if you have a really good connection with the seller, you can form a friendship with the seller. For this transaction, you're going to be emotionless. You're going to take emotion out of it, and it's going to be a business transaction. It's going to be a business dealing that you're doing.
Goal is number one, get information. Number two, conceal information. If you're getting a divorce, the acquirer doesn't need to hear about it. If your wife is badgering you to buy the $5 million yacht for the vacation you've got planned next March and you need to get the company sold, don't talk about it. If you're facing a bankruptcy situation or anything that potentially increases the necessity or desire for you to do a deal, concealing that is not wrong, right? Just don't talk about it. But figure out what the other side's up to.
So if we can see that actually we can get into a M&A transaction and the sell side is hiding information which could be detrimental to the business as well. So if they're hiding information which could be potentially detrimental to the sale, because bankruptcy is a personal situation. The wife telling the husband that they need to sell the business or they need to get the $5 million yacht. That is a personal situation. But that doesn't mean that people don't hide bad things about a business or they don't hide things that you need to know about the business. They hide things all the time. And I mean, that's why the due diligence process is there, which of course is done after LOI, heads of terms are all signed. But you need to try to as much information that you can gather before submitting a heads of terms and LOI. Because when you are gathering this information and you're extracting this information and you're uncovering this information before you get to heads of terms and LOI, you've normally spent less money in the transaction. Time, money, professionals, resources. You've normally spent only a limited amount of time. So the more you can extract out before that is better, because once you've got heads of terms and LOI, that's when the lawyers and accountants really put the steam on. And other professional advisors, they really get involved, and that's when your costs start racking up. Even if you've got fixed fee costs, it doesn't matter. It starts getting, the time starts accumulating from that time. So try to extract as much information as possible. And remember, people conceal things, not just about their personal situations, but also about the business. Not everyone is 100% ethical and moral when they're doing business transactions. And to be fair, if you're selling a business, are you going to voluntarily tell people about anything which could be detrimental to their perception of your business? You're not. Only if they are able to uncover that information and it comes to light, then you start talking about it. So this is a normal human nature aspect of things, and you need to be careful about it on buy side.
Why does the operator from the acquirer want to do this deal? How much value is he going to be able to create? So, hey, John, I love the fact that you guys are interested in my company. It's taken me my whole life to build this. I really want to find the right home for it. I care a tremendous amount about my people. You seem like the right guy to be able to pull this off. If we combine these two businesses, what are you going to do with it?
Right. So Paul just mentioned those magical words. I care about my people. I care about my brand. I've built this up over time. I'm very passionate about what's going to happen after sale. These are the things you can capitalize on and attract or get further attraction from the seller from buy side. So it's not just always about price. It's also about these things as well, amongst others.
Like, how are you going to be able to create value for XYZ Corp? Now, John's an operator. He's not a negotiator. Like, you might have the corp dev guys there, you might have an M&A guy, but they often bring an operator who actually can understand your business. And the operator might say, hey, this here pest control business, $50 million business. Here's what I'm going to do. If I combine it in my area, I can get increased route density. I can shave off, 300 basis points of cost off the gross margin line. We've got a lot of redundancies here. I can remove $1 million in cost here. I can do all these sorts of things. Hey, you guys have a great capability. I can take this mosquito capability and roll it all across $1 billion in revenue and increase my set. These guys will go on and on and on and on. And that's what we need to know, because at the end of the day, when we get to the end of the process, we are going to reverse engineer. We're going to say, okay, how much value can acquire A create by doing this deal? Now,
Before he moves on to what his next point is, let's look at this sentence here. How much value can an acquirer create by doing this deal? This is called strategic value of a business. And Paul is going to mention something now, and we'll let him mention it. But your operators, when they go in, your industry experts, when they go in, your people who are analyzing deal from the operational standpoint, they must be told that they're not allowed to talk about anything to give away the secrets of, essentially, trade secrets of your business. I made this mistake myself. So I was looking to purchase a business, and that business was a great business, by the way. One of the best businesses that I looked at for long-term potential. And we told them everything that they're going to, we are going to do to the business. They pulled out with the week of signing, and they implemented everything that we told them, and they made their business more valuable, and they sold it to someone else. Imagine how gutted we were. That was a 200 odd thousand, 215,000 pounds mistake. That was, right? So strategic value, operators, all of these, no one's allowed to talk about this at all. Not the M&A negotiator, not anyone. So you look at deals from the perspective of the deal itself. So each deal is in its own isolation. You will see slightly more sophisticated sellers or business people. They will ask, What value is my business going to bring to yours? What are you going to do? How is that going to improve your business? And you need to just withhold that information as much as possible and not talk about that. And my simple sentence that I normally say to people is that, look, we're looking at this business. If it stands on its own 2 feet and as a standalone business. So let's concentrate on your business, or let's concentrate on the business at hand, and we can talk about that further. And they're normally perfectly fine with that.
In theory, all synergies created in a deal, whether revenue enhancements or cost synergies, should belong to the buyer because they're writing a check. That's not the way the world works when I've got a bunch of competitors vying to buy a company.
All synergies belong, or deal value creation belongs to the buyer. That's how M&A buyers, we look at the process. Anything that we can achieve from your business after the transaction belongs to us. So therefore, we don't want to pay you for that because we're going to create that value. You haven't created it. So therefore, we're going to pay you fair market value for your business, or intrinsic value if you can, and you're going to sell it for that price. Because if you were going to create that, you would have created it already.
We're going to extract as much of that value creation for ourselves, the sell side. And if we really understand what that looks like, because we've asked the right questions, we didn't talk too much, we were friendly, and we got everyone else talking to us, like, what are their incentives? Like, hey, John, you're the operator. Like, if you do this deal, what happens? Like, how does this impact you? Well, my budget's going to be bigger, and if I get this thing, might increase my bonus by 20%. That's great. M&A guy, I get bonused on how much capital I commit. So now we know that, hey, I've got some direct buy-in from these guys. Like, I'm negotiating with a corporation, but am I really? No, I'm negotiating with guys who have jobs, who have families, who want money. And now they've just revealed to me that they've got financial incentives. Like, if I was blabbering the whole time and talking, I would have figured that out. So figure that out.
That's also important to understand, that you're dealing with individuals. Even though you're buying a business, you're dealing with the owners. The owners are individuals. So I was once dealing with two partners, and those two partners had different perspectives of what they wanted to achieve out of the business sale. So what I did is that I set up separate meetings from them. So every single time they were coming on a meeting, they were coming together. But then I figured out that they want slightly different things. So then I had a separate meeting with one of the sellers, and there's a separate meeting with one of the sellers, and I deeply understood what their individual motivations were, and I started playing to those individual motivations. And that's what you need to understand. You're dealing with individuals, with people. He's saying about the buy side M&A person, the operator, so on and so on. From our perspective, we're dealing with the owner. What do they want? What does the wife want? What does the husband want? What does the significant other want? And what are they going to do with this business sale? If we can help them to achieve that by paying the lowest price possible by us, well, from our perspective, then that is a win for us.
Because we're going to use that. Now, before we move on from this meeting, which effectively is a first date, I want to break this down a little bit, and I want to talk about roles here. Now, as an investment banker, it's my job to prepare you with questions, help you figure out the questions, help you understand who you're talking to, help you understand what it is they're going to want to understand from you, the business owner. And you should really think about this as almost a first date with a woman. You are a handsome, charming man, quite successful. You meet a girl. You have a conversation, you exchange a number. Now, this woman doesn't know you, right? And so she's had a quick conversation with you. She likes the way you look. You seem to be reasonably successful. You're charming. So you exchange numbers, you set up a date with her, and you go on with your life. Now, while you're going on your day-to-day business, in the same way the acquirers have read the sim and they're going on their day-to-day business, she's beginning to think about who you are as a man. And again, she doesn't know much about you, so she's creating these images in her mind of what you could be, right? Is this her final opportunity to quit dating, right? Does she finally find the guy, and are you the guy? And she's creating these ideas in her head of who you are. So how do guys screw this up? They go on the date, they talk about themselves the whole time, they run interview questions with a woman, they basically ruin the illusion. So the image that she had in her mind of who you are, like you've actually told her who you are, and that's not exactly what she was thinking. So don't screw this up, right? It's the same way with the meetings with the acquirers. Like, you're going to continue to be the charming, handsome man. You've done well for yourself, got the nice company. You're going to be friendly. You're going to be playful. You're going to listen to questions. You're going to answer them. You're going to ask engaging, thoughtful, open-ended questions. But at the end of the day, there's nothing that you're going to be able to do at this meeting to cause somebody to say, hey, I definitely want to pay more for this business because this guy is so awesome. But you have this distinct opportunity of turning them off. And
before coming to this turning off question, creating the illusion. This is a very, very important. So what I like to do is, remember early on in this video, we were talking about motivated sellers. To understand the motivations of why someone is selling their business. Once we understand that, we want to continually bring the seller back to a vision of themselves post-acquisition. What does that look like? If they're sick, then does that mean that they can relax at home? They have no pressure of the business. They have mental relaxation or mental clarity, and they can focus on getting better. If, for example, they're retiring and they want to move to another country, spend more time in their holiday home, then does that look like that? So if we can understand the motivations of the seller and then really create that picture in their mind and keep bringing them back to that same vision, right? This is what I'm going to do once I've sold the business, then that is going to continuously re-motivate them to get the deal to completion and sell the business to you.
saying like, hey, we'll buy this, but we're not paying a crazy price, or we're just not interested. So going into these meetings, you're not looking to dazzle, you're looking to do damage mitigation at all costs. That's how you have to look at this. And from my perspective as a banker, what I'm trying to do is I'm trying to mold perception on the part.
From a buyer perspective, we are also reducing risk, damage mitigation, damage control. Any transaction, any investment that you buy is a risk. In fact, when you're hiring a staff member, that's a risk because you're committing to salary. So these are big transactions. You're normally going to transact in the millions for these businesses. So when you go to buy a business, you need to try to understand the whole upside, but also what's the downside. So when you're extracting information from the seller and the management team, and you're doing due diligence and you're looking at the legal and the accounting side of things, you need to understand what's my downside as well. If you can protect your downside as much as possible, then that's going to be an advantageous situation for yourself.
Part of the acquirer, I'm not only trying to ferret out information, I'm taking notes, but I'm also trying to make sure that the acquirer understands that you've got a lot of options. And you're going to naturally come off like you have a lot of options because you just met with 10 different women in a 3-day period. You're super excited, right? You're the guy at the bar and all the chicks are coming up to you. That's how I want you to feel. And that's how I want you to naturally come off. And so doing these meetings and getting yourself into this mindset, I think is very, very important. Because again, as I said earlier in the discussion, so much of this is perception versus reality, and so much of this negotiation game here is psychology. So we've got you high on your own supply, you're all hopped up, you're charming, and you're funny, and you're humorous, and you're asking great questions, and you have a good meeting, and you're very friendly to the acquirers, and then we move on to the next day. After all the meetings are done, now it's time for us to ask acquirers to tender a formal LOI. Now, up front, they may have given us an IOI and then an LOI, but now we're going to ask them to revise their bid once again. And in a sell-side process, I never know how many rounds of bidding there will be. Sometimes there's 1, sometimes there's 10. I never know. But what I'm trying to do is each round, eliminate acquirers. Push everyone up higher, and the lower ones, I want to boot them from the process. So on day two, I ask for revised bids. And I say, next Monday at 5 p.m., please tender your revised offer in order to effectively stay in the process. And we will continue to do that. And every time I ask for a revised bid, I'm providing more information. So, of course, after that initial date that you had with them, the acquirers will have a lot more questions, right? I'm going to ask for a revised bid, and they're going to say, hey, we need to understand trends in gross margins and what's going on with this big client. And we noticed this, and we had issues about HR that we talked about, and how can we grapple with that? A million different questions. But we will answer those acquirers' questions, but in exchange for that, they're going to have to come in with a higher bid. And, the best way to deal with that, and again, every process is unique. What I will typically do is, let's say after management meetings, now I have 5 bona fide acquirers that want to do the deal. We had 10, 3 fell out, then we have 7, now we have 2 fell out, we have 5. So now I've got 5 bidders that have all asked me questions. We're going to take all of those questions and we're going to amalgamate them. So 5 acquirers, each give us 10 questions. Now we've got 50 questions. We're going to answer all of those questions, and we're going to spend time going through them, and we're going to, and we might even add some additional questions to it. Who knows? Like, we just might add a few extra questions. And we're going to shape this, and we will send this question package, this data package, out to all acquirers simultaneously.
You want to try to get the data room or as much data as possible as early on as possible, potentially even before signing a heads of terms or LOI document. I try to extract as much information as possible, especially financial and legal, before signing any LOI documents or heads of terms documents. By the way, LOI and heads of terms are the same thing, which in the UK we use heads of terms. Pretty much everywhere else they use LOI. LOI stands for letter of intent. So the more information you can gather from sellers, ideally just get access to a data room, the better it is for you. And with regards to this bidding process, remember, we don't normally go through any bidding processes like this. We are exclusively normally talking to people, and if not, there's maybe 1 or 2 other people, but we wow people with other things that are important to the seller.
And we're going to do that because oftentimes it's important for other buyers to see some of the questions that other buyers are asking. Now, on occasion, there are questions in there that do us no good. Sometimes an acquirer could be more informed about a business or about the principles of a business than others. Somebody might have had a drunk driving issue, for example, and it was one acquirer that found that. That's not relevant to the transaction. You're the seller, you got nailed for drunk driving. You're not going to be a part of the acquisition going forward. They shouldn't care about your driving record. It's not relevant to the discussion. An acquirer does some research, they find this record, they may do a background search, they ask some questions about it. I'm not going to put that in the questionnaire package because I don't want to draw attention to something that is not relevant or germane in any way, shape, or form and should not have any impact on your deal. So I'm going to remove that. But for the most part, the big list of questions go out to all of the acquirers, and now they're like, okay, there are a lot of folks looking at this. There are a lot of folks asking a lot of questions. We need to sharpen our pencil. It's time for the next round. Let's bid. And we continue to ask them to revise your bid forward until acquirers fall out. And, I oftentimes find myself in a position where there might be 2, right? Depending upon how we're running the process, we might ultimately, at the end of the bidding, we might sign either a letter of intent or we might sign an exclusivity agreement and allow 2 or more acquirers to do diligence simultaneously.
Now, you never want to be in that situation where you're signing a document which allows another party to be privy to your exclusivity period. I refuse to do that. I've never had that situation. I mean, to be perfectly honest, it's in this sell side masterclass that is the first time I've even heard of the situation. But if that was to ever occur, never ever sign a document which allows another party to be privy to your exclusivity period, and therefore two potential acquirers in this case are doing due diligence or working towards completion. That's just a recipe for disaster.
Now, allowing two or more acquirers to do diligence simultaneously is more similar to a full controlled auction rather than a modified auction. In a modified auction, you're typically signing a letter of intent with one acquirer who has exclusive access to deal materials. But we're going to continue this process until we get to the best terms. And I always tell every client, like, from a psychological perspective, you absolutely need to be agnostic as to who's going to do this deal. And 50% of the time, clients will say, hey, I know I've got a bunch of options, but I really like acquirer A. They have a very similar culture to us. I've known those guys for years. I think my company would meld very well with theirs. And while that may be all well and good, and all of those things true, at the end of the day, we're selling a business here, so we're focused on money and terms. And that acquirer should be treated just like every other acquirer, and they should go through the process simultaneously with the others. And you shouldn't fall in love. The second you start falling in love with one particular acquirer, now you have that disparity of desire. Like, you only have eyes for that particular acquirer. You want to do a deal and you're willing to make accommodations, and that actually comes out in the process. So you need to attempt to blind yourself from that. Look at all acquirers equally and let the facts speak for themselves when we get towards the end of the bidding process. Once we start getting towards the end of the bidding process, it's very, very important for us to think about how leverage is played out throughout the acquisition mating dance, right? So we brought a lot of acquirers in, which gave you optionality, right? You were the dude with all the chicks after you. It allowed you to really bid up the price of your business. And we demonstrated that, right? We demonstrated to the acquirers that they had a lot of competition and they were going to have to pay to play. We concealed information throughout. You did a fantastic job on those management meetings. You were fun, you were playful, you were passionate about your business, you asked some great questions, you didn't bloviate, you did exactly what you were supposed to do, and all the acquirers loved you. Great job. You concealed information, right? You didn't talk about your wants, needs, desires. You were focused on them. And you extracted as much information as possible. And by doing that, you allowed me to really understand how much value these guys are going to be creating by doing the deal, which allowed me to push really, really, really hard when they were revising their bids. Somebody comes back with a $50 million bid. I was like, hey, listen, you're creating a lot of value here. It's going to take you at least 60 to get to the next round. That 50 is just not going to cut it. But you helped me do that because you played your cards right and you did the right thing in the management meeting. We've remained very credible throughout this process. We remain credible, and we've done that because we haven't had to really negotiate yet, right? We have let the process negotiate for us. I haven't had to have any direct negotiations with any of those acquirers. You've done a great job dealing with the management meeting. You've been cool and detached. You haven't gotten upset. You saw some low offers. You didn't get frustrated. You're like, this is how it works. So I'm going to trust the process and let this happen. So right now, because we're not doing any direct negotiation, all of that negotiation has been on the other side of the table. Those are those acquirers competing. And when negotiation takes place on the other side of the table amongst themselves, we are running an auction. But now as we start to get towards the meeting of the minds, it's when we sign a letter of intent. That's when leverage can abruptly shift from our side of the table to the buy side, right?
So that's 100% true. As soon as the heads of terms, the LOI document has been signed, then the leverage and the power shifts to the buyer, because you will have, and in here he's going to say 60-day exclusivity. Generally speaking, I advise all of my clients and even us ourselves, you can do 90-day exclusivity period minimum, because it can take that time. It can take longer, in fact, but 90 days is ideal to get the exclusivity. Sometimes we've managed to get 120 days, and it's ultimately whoever's writing the document is going to write the first bit of terms. And that's why you should write the LOI, the heads of terms, whatever document you're writing, and get them to then sign that. So you have the starting position, and then they're negotiating off that.
The second that we sign a letter of intent, we're not binding ourselves to doing a deal with an acquirer. If the LOI is appropriately structured, really,
Heads of terms document or a LOI document does not bind either side to completing the transaction, nor does it actually even bind you to the price and the terms. However, that does form the basis of the price and the terms. What the LOI and the LOI and the heads of terms does, it gives buyer exclusivity to conduct a due diligence on the business and then ultimately get it to completion, and hopefully get it to completion. From your side, you want to get it to completion. The seller normally wants to get it to completion by that point too as well. Up until the LOI and heads of terms document, the seller's probably already started spending quite a lot of money because producing all of these documents, producing the SIM or the IM, all of these documents, it takes time, it takes money. So they've probably spent a bit of money on that, and they've got some, financial and emotional buy-in, and that's good for you. And especially once the LOI and heads of terms has been signed, and now that's come into your favor, you've got the power and the leverage, you can really start pushing on that and taking advantage of the situation where the power is now shifted in your side. But ultimately, always remember, heads of terms LOI document does not bind you to completing the deal. All it does is forms the basis of the transaction.
really what it does is it binds us into confidentiality, right? We can't talk about the deal. It binds us into a period of exclusivity. And exclusivity means that the acquirer will have sole and exclusive access to data, finances, resources of the company to do their final assessment while they're drafting a purchase agreement prior to the closing. And as part of that exclusive agreement, that means we have a no-shop provision. That means we cannot talk to other acquirers, right? We can't say anything to them. And a lot of times, a buyer will want, like if another acquirer comes to us in an exclusivity period, that we actually have to notify them, like, hey, a buyer showed up at our door and wants to talk. So we lose a lot of leverage when we get into exclusivity, because we lose one of the most important aspects of leverage, which is competition. Because once we sign that LOI, those other buyers are gone. We tell them, hey, we just got into exclusivity with an acquirer. Thanks for playing. You didn't make the deal. Now, the ability to enter into exclusivity is powerful for us because they know we're going to enter into exclusivity with somebody and we want that to be them. So we want them to really put their best foot forward and pay a lot of money for this business so they can win exclusivity. But at some point, one party is going to get it. So given the fact that leverage will shift dramatically once we get into exclusivity, we have to make sure that we've really thought about all the things that are important to us in this deal, and we get them in the letter of intent. So throughout this whole process of dealing with iterative bids, going to management meetings, answering questions, we've been having conversations over the last few weeks and really looking at all the other letters of intent. And every time we've gone through a bid process or an iterative bid round, we're making comments on the letter of intent, saying, hey, acquirer A, the lease term should be 5 years and not 3. And hey, acquirer B, we're not willing to sell this. This is an excluded asset. So we're revising these LOIs as we go through this process. But now, when the rubber meets the road, we need to make sure that we're really thinking ahead to the asset purchase agreement or the stock purchase agreement. And that definitive agreement is actually the binding document that we would sign sometime prior to the closing or at the closing. And then money will change hands. And then once money changes hands, the deal is bound. You don't own the business anymore. So it's important for somebody like me, as well as your legal counsel, to make sure you start to understand what sort of provisions will be in a definitive purchase agreement as we're going through this negotiation process to get to the letter of intent. There's things like reps and warranties, indemnifications, caps and baskets. There's a variety of legal aspects that will actually make a difference in your life post-closing that we need to make sure that we ask for at the LOI stage. And I'll do some subsequent sessions on some of those key points so you could be better prepared for that. But for our purposes right now, since I'm focusing on negotiation and these dynamics, it's really important to make sure that we ask for and get everything that we possibly can prior to signing the LOI, because at that point we lose leverage. In this,
From a buyer's perspective, I always advise that you should make the heads of terms in the LOI document as simple as possible. Of course, from sell side, the more you can get into the LOI to the heads of terms with regards to reps and warranties and the baskets and all of these caps that need to be put into place, which protect sellers post completion, they do try to put as much as possible, or in fact, sophisticated sellers who have good counsel put that into the LOI and the heads of terms. Now, I only ever met one person who actually did it to the level that Paul is talking about. However, every other time, including myself and clients, and also friends who I've helped purchase businesses, we've always managed to get a simple, buy-side friendly heads of terms and letter of intent document. And that's what you want to try and achieve as a buyer, a really simple document which is buy-side friendly, and therefore it allows you more flexibility as the process goes on to completion.
this particular case, let's say that the 5 bidders actually stayed in, and we ended up signing an LOI with one of them, right? It would be not common that all 5 would stand to the very end, but I want to make this super easy. So 5 stayed in. So we're telling 4, thanks. We've decided to move forward with another party. Thank you for participating. We'll see you on the next one. Those 4 go on their way, and now we have to make sure that this acquirer closes this transaction. And we're going to be in a different phase of negotiation now. Up until this point, we haven't had to do a lot of direct negotiation, right? We've let the process negotiate for us. I've never had to call up and fight about terms. I just say, hey, listen, you do this or you don't. If you do this, you stay in the process. If you don't, bye-bye. Now, once we sign the LOI, it's not that easy, right? Like, we can't say bye-bye because we can't talk to any other buyers, and we're under exclusivity for the next 60 days, so we can't threaten to walk away. We're already in this. Now, we can walk away if those guys are belligerent or we decide we don't want to do the deal, but it's not a negotiating tactic.
Just to reiterate here, you want to get exclusivity for at least 90 days, ideally longer. Sometimes we've got it for 120 days, and the longer the better. 60 days, in my experience, is it's actually not short, but we've always managed to get at least 90 days. And we advise all of our clients for 90 days minimum.
So we have to think about the psychology of negotiating once we're under exclusivity, which is very different because now we're negotiating directly with that one party. And inevitably, there's going to be terms that will need to be negotiated. And this is where judgment is extremely important. This is where the credibility that we've built up through the entire process will bode well for us. The information that we've gathered, the competitive pressure that we've put on, and if we've done a great job, we've probably put together a deal that's extremely expensive for the buyer. And so, like, it's not unusual for the buyer to be like, I'm paying a lot of money for this business, so now I sure as hell am going to make sure I'm protecting this legal document. And if we haven't thought through that at the LOI stage and gotten as much of that as we can in the LOI, as soon as we sign it, the buyer's going to say, hey, I'm paying a lot of money, so there's going to be a lot on the line for you. So we need to make sure that we've talked about escrows, right? A lot of times acquirers will.
Before going into the conversation of escrows, I always say to everyone, buy the biggest deal that you can at that time. And when I say that you can, even what you can't. So raise finance as much as possible, even if you've got retained capital in your business. So let's say you've got retained earnings of 1.5 million. You take that out as dividend, you're going to have a heavy tax bill. So instead of using that 1.5 million for dividends, why don't you redeploy that capital? But if you've got 1.5 million retained earnings, go and raise another 3 million from somewhere, right? And then go and buy a business which is bigger. And if you've got some seller finance and earnouts, then you're going to be buying a significant size business. So buy the biggest business that you can possible. And why do I mention that here? Is because Paul mentioned that the buyers probably spent a lot of money and they're spending, it's going to be an extremely expensive deal for the buyer. That's what I'm saying. It should be an expensive deal for you because you're buying a business which is big. That doesn't mean you're overpaying for the business. It means the business itself is actually of a good size and you're getting that for a fair price, but it's still quite expensive. But that's ultimately beneficial for you.
Offer $20 million for a business, it might be all cash at the closing. And we structure the deal, we sign the LOI, and then we get
And never do all cash on closing. Never, ever, ever. Even if you're just holding back 5 to 10%, never do 100% cash on closing.
into the purchase agreement negotiation phase, and somebody says, yeah, well, we need a $2 million escrow. That wasn't in the LOI. Well, the LOI was signed on that, but that's standard practice. And so now we're negotiating escrows, right? And so we need to make sure that in the LOI, we specifically, if it's 20 million all cash deal, like there is no escrow. And if there's reps and warranty insurance, who's paying for that? And how is it being split and all those sorts of things? And I can really go down a rabbit hole on this, but there are inevitable things that will pop up that we can't anticipate. Let's say that you are a residential services business, and although the acquirers did a lot of work upfront prior to making offers and prior to signing a letter of intent, the acquirer whom we chose to walk down the aisle with discovered some things that increased the risk of the business, maybe customer concentration, and they figured that out with diligence after signing the LOI. And they came back to us in good faith and said, hey, we have a problem here. There's a lot of customer concentration. If this big customer leaves, we didn't realize this before. We're going to end up leaving a lot of money on the table. And we, in good faith, want to work with that buyer. They might propose something like a special indemnity holdback. They might say, well, post-closing, you have to retain this client or client group for a 1-year period. And if you're able to do that, then you'll get the $2 million that I'm putting in this holdback back. We're just going to hold your money. It's your money, but we're holding it. If we lose these accounts, we take this money.
In that situation, you don't want to actually get your capital and tie it up in escrow. You want to put that into a deferred consideration agreement. So basically, or more specifically, an earnout, in fact. Say, look, you've got this large customer, huge customer concentration, and that's a risk for us. And of course, we're going to take over the business. And if this customer continues to be the customer of the business, as you have said that they will be a customer of the business, then you will be paid on an earnout basis. So don't tie up your capital in escrow, but have earnout agreements. So therefore, you can use your capital elsewhere. And what that also does is that it gets a business to completion, and you can use the cash flow of the business to then pay that earnout payment.
And we don't have the ability to walk away unless we want to kill the deal, which we don't want to kill the deal because we just spent 3 months negotiating an awesome deal. But we also don't want them to hold $2 million of our money and make it contingent upon customers that we'll have no control over post-closing. And so it's about finding common ground, and that's in some way where a lot of the cooperative aspects of negotiations come into play. I mean, the acquirer certainly doesn't want to lose those accounts. And I think a lot of sellers get really frustrated, and this is where you need to remain cool and detached. In a situation like this, a seller would typically feel like this is a personal affront to them. Like, they waited to sign the LOI, they could have done the research before, now we locked it up for them, and they're trying to gun for us. Now, it's possible, and that does happen. But in this particular case, let's say that's not the case. Say they're doing this in good faith.
Right, you will find sellers get very emotional because don't forget, when you're buying a business, normally you're buying something which is the seller's owned for, started it from scratch, startup, founder. She takes it to, 20 million in revenue, 10 million in revenue, large, there may be like, 50 to 100 employees in the business. That's their baby, right? They have built that up. We bought a business where we met the children of the owner, and the children said that this business is older than us, right? Meaning older than the children. So to the seller, this is something which is very emotional sometimes, and that's why we like it. We actually like it when sellers get a little bit emotional regarding the business. but not too emotional that they start feeling that, diligence on the business, due diligence on the business, and observations on the business is a personal attack on them. So you need to, as a buyer, actually be very careful about that. Don't be insensitive about things that you highlight about a business, which is an area of improvement. So if it's a negotiating point, then you bring it up with respect. And when you do that, then you will get some respect from the seller and potentially the favorable negotiation terms that you're trying to negotiate, or negotiation outcomes that you're trying to negotiate.
This is the point in time for you as a seller to remain calm, cool, and collected and say, okay, we've got a problem that we've got to figure out how to solve. And typically, and not always, but typically what will happen is the acquirer will make a proposal and then we'll make a counter proposal. They might say $2 million and we say that's way too much, but we're willing to do something because we recognize it's a problem and we recognize you're operating in good faith. So we're willing to do $500K. And so now we've got that delta between $500K and $2 million. And oftentimes this is kind of a standard positional bargaining concession pattern, right? Where we are going back and forth. They say $2 million, we say $500,000. They say 1.5 million, we say 750,000, right? And so we've demonstrated to them that we made a $500,000 movement, but we're getting much closer to our walkaway point, so we're going to lower the concession amount. And usually concession amounts, as they go forward, they are in smaller and smaller increments. This is another area where time matters. Time with regard to deadlines, time with regard to investment, and now time with regard to acceptance. So the initial gut reaction of a seller is like, fuck off, go pound sand, I'm not doing a deal. But the reality is you want to do a deal, the price is right, we do recognize that this is an issue, so let's try to work through this. And we're doing our positional bargaining, counter offer. This is important time for sellers to relax and slow things down. Because, I think if my VP were sitting here, he would say the most important thing that he's ever learned from me is do nothing. Oftentimes as negotiators, we want to act. You as a seller are going to be under emotional duress. You're going to want to act. Sometimes the best thing you can do is slow down. And if you've got a good acquirer who's investing a lot of money and now they're in diligence and they're spending hundreds of thousands of dollars on lawyers, on financial advisors, on accountants to go through your company, they got HR experts coming in, they're spending a lot of money to get this deal done, but they probably don't want to walk away from it. But they need to be able to save face. It's really...
Always be ready to walk away from a deal. The business in which you are not ready to walk away from the deal is normally going to be the one that is going to return you the lowest return on investment. So always be ready to walk away from a deal, regardless how far you're down the line, regardless of how much you've spent on that transaction. Ultimately, you need to be controlling your costs, of course, even in a transaction, in a due diligence process. So minimize your costs, minimize your risk, but always be ready to walk away. That's the mistake that some acquirers make. I made that mistake once and I'll never make it again. And I ensure that no one else ever makes that mistake.
Difficult for corporate guys to go back to their boss and say, hey, we discovered this. We should have found it earlier, but we didn't. And we tried to work with the seller and the seller's telling us, no way, you're trying to screw us. It's not a good position to be in because, of course, the boss is far away from the negotiating table. He hasn't invested the personal time. He doesn't have the relationship with the seller. It's very easy for him to say, forget it. Like, if that seller wants to be hard, I gotta just walk away from this deal. So sometimes you just have to accept the offer, make your counter proposal. They'll make another counter proposal, and then you just wait and you sit on it and you relax and you fight all your natural instincts to get your arms up in the air and fight this, and you just relax. And sometimes time does heal those wounds. Sometimes the acquirer does more work, and more times than not, they'll come back and say, hey, I think we can make this work. If you're willing to do X, we'll just get this done. And ideally, you'll find yourself in a position that you ended up getting a better term than you otherwise would have gotten had you immediately engaged them. So there's acceptance time. And, I think it's very important for people on the buy side to understand this, probably more so than people on the sell side. And when you're on the buy side, you're often disappointing people because sellers often want more than they should get. And that's a fundamental rule here. It's very rare for sellers to come in and say, you know what, my business is, maybe it's worth 20, but I'll accept 10. That doesn't usually happen. And so oftentimes buyers are giving sellers offers. If you imagine yourself in a direct negotiation with somebody, you're trying to buy his business, and you look objectively at the business and you say to yourself, okay, it's worth $2 million. The question you always have is, who makes the offer first? Is it the seller needs to put an asking price on it? If you, the buyer, do you make the first offer? How do you handle that? And, those particular cases, I often say whoever has the most information and has the most knowledge about the business, who's more of a specialist in that particular asset class, should go first with an offer. Because if you listen to a crazy seller who's not particularly sophisticated, they're going to start throwing some crazy numbers around. And you're going to end up, look, you got a $2 million business. My asking price is $5 million. Well, now you're negotiating off his $5 million asking price. So even $2 million, which you think is reasonable, is going to sound ridiculous to him. When I talk about acceptance time, it's about you as the buyer taking control of the process.
This is extremely true. We have to take control of the process as buyers. And on the question of inflated or unrealistic valuations and who should make the offer, you should always make the offer first. And you should make a ridiculously low offer, right? Because sometimes it gets accepted. And you'd be surprised what sellers are motivated sellers. Remember, the key thing is motivated sellers. You'd be surprised what offers get accepted. So in a particular situation, it's happened a couple of times, but this one is the best one, is that all of my advisors, every single one, was telling me I wanted to make a low offer. Every single one of them was saying to me, don't make that low offer, it's too low. And, you're going to lose the deal, whatever it may be. It's really early days. I didn't listen to any, I said yes, or whatever. I didn't listen to them. I made the offer, really low offer, and it got accepted. And then I realized that even that offer was too high. It was a very, very good, I think that was a 1.8 multiple on EBITDA. That's what ended up getting accepted. 1.9, yeah? Which is, if you know about valuations, that's a good valuation. And that was accepted on first offer, first acceptance. And I realized I could have got lower and got it for an even better deal. Now, obviously, that gave us great margin of safety. It was a great deal. We went ahead with it, and we now own that business. So take control of the process, and always you make the first offer first. Even just 3 days ago, I made an offer on a business, and I was not expecting it to come back with any positive comments. And the seller came back with, but they didn't accept it, but they came back with questions regarding the offer, which means it wasn't a no. So always take control of the process.
Right. If you can, as a buyer on the sell side, I'm always trying to control process. I'm negotiating process rules. I'm trying to control process. When you're a buyer, you want to take control of the process, and you step in. You make that unilateral bid or proposal to buy the business, and let's say that you'd reasonably expect to pay $2 million for it. You might come in at 1.5, something to not insult him, but also give yourself plenty of room to negotiate up to that $2 million. And when I say acceptance time is, in his mind, he wants $5 million for that. He's not going to accept that overnight, right? He's going to unilaterally reject your proposal and say, hey, I'm not even willing to talk to you. When you're serious, let's sit down and talk. But 1.5 is ridiculous. It might take him a week. It might take him a month. It might take him 6 months to realize that. He needs to, whenever we get bad news, whenever we get news that is dramatically different than our expectations, we don't immediately accept it, right? We have to sit back and process it, and it takes time. And I feel like sometimes buyers really end up working themselves out of a deal when they don't understand acceptance time. And so I know this is a sell side discussion, and this was a little aside for you, but it's an important aspect is acceptance time. Let the other side accept the situation as to where they are. Let them understand what could potentially happen going forward if they don't see things the way that you do. And then sit back and wait.
Yeah, this is a really important lesson about acceptance time. Giving the other side time to process the information, process the bid, process whatever it is that you've thrown their way, and for them to understand it. And that's why normally when I am making a proposal or giving a negotiating point, I try to give a very summarized, not too much information, but a quick summary as to why I have suggested such a thing. So it gives the seller a bit of an understanding as to why I've said this. And if you're dealing with someone who's an investor, who's a seller, meaning they understand investments, they understand business properly, they should be able to respect, even if they don't accept it 100%, they come back with a pushback. They will be able to, they will be able to appreciate what offer you've made, and they will respect you even further.
The the most important thing that you can always do as a seller is control that process. You control the deadlines, you control the timeline. You have the ability to speed things up, but you also to slow things down. And remember, exclusivity, if you've negotiated the LOI correctly, exclusivity does not last in perpetuity. So you might have signed up for 60 days of exclusivity. The buyer comes to you and says, hey, I want this $2 million escrow or hold back. You don't want to do it. You can let the shot clock run out, right? That exclusivity will expire. They're spending a lot of money. It'll expire in 60 days. You can go out and talk to other acquirers. You can go back to everyone that you talked to before and say, hey, it didn't work out with that buyer. I'd like to do business with you. Now, you're not putting them in a position of strength, right? Now you're demonstrating desire to do a deal with them. So I don't know that I would suspect that you would get the exact same price and terms as they had offered you before. It's possible sometimes if they still really want to do the deal, but it's not always the case. But just remember acceptance time. Now that we've talked about the formal sell side process and the right things to do, I want to spend a little bit of time on the wrong things to do. One of the biggest mistakes that I see sellers make is negotiating with one buyer. And that's wrong for a variety of reasons. First off,
So I believe everything that Paul is going to mention in the wrong things to do is the right thing to do from buy side perspective. So I will let him do the talking here.
as we know, if you've got one buyer, there's no competition. So the buyer has no reason to act because it's usually loss aversion that makes people act. So the buyer has no reason to act. You've ceded control of the process to the buyer. If you're only negotiating with one buyer, the buyer now is negotiating process as well as substance, and the buyer is controlling that process. So you're ceding leverage to the buyer. I think another one that folks often don't think about, though, is the failure to get price discovery. You know, competition clearly pushes up the value of an asset, but when you negotiate with one buyer and you consummate a transaction, after the deal's done, can you really look back and say, I did the best for myself? You know, if you brought in no other buyers, knowing that valuation is subjective, right? It is arrived at the bargaining table. There's no price tag on a business. So if you negotiate with only one buyer and then find yourself in a position where you closed a transaction and brought no other acquirers in, you never got price discovery. And it's one of the biggest regrets that I hear from people after having sold a business, negotiating with the private equity firm that just called them up out of the blue and said, we're the best buyer and we'll pay you the most, is, did I really do the right thing? And you know, those sellers over time want to somewhat close their ears to the transaction multiples they hear that others are getting because their deal is already done. But again, if you want to do the best thing for yourself, at bare minimum, if you don't run a formal process, if you ignore everything else that I say, bring competition into the mix. That's number one. Another big mistake sellers make is going into this without a plan, right? If you're going to sell your business, you need to spend time up front, hire experts, figure out what some reasonable expectations are because, you know, pain really comes from that gap between expectations and reality.
This is a really important point. As a buyer, you need to know more about the buying process, the strategies that are used in an M&A transaction, or the tactics, in fact, so strategy is not the right way, the tactics which are used in an M&A transaction to get the best from buy side. You need to know how that is. So you need to get the right advisors to ensure that you can go into a process with confidence and get the best deal for yourself and your business.
If you walk into this with expectations that are far above what you're ultimately going to get, it will be a painful process for you. So formulate a plan before you wade into the market. Set your reasonable expectations. Build competition for your business. Use time and deadlines as leverage. Ferret out information on the other side that helps you understand the disparity of desire. Conceal information that potentially exerts negative leverage on you. Build credibility over time, doing what you said you would do, and properly giving positive and negative feedback to the other side. If you can do these things, all else being equal, I promise you, you will raise the value of your business. The biggest mistake that you can make as a seller is negotiating directly with one buyer. When you negotiate directly with one buyer, you're effectively ceding the process or control of the process to the buyer. The buyer's setting the rules. The buyer has no reason to act. In absence of competition, the buyer has no reason to do anything at all, so they can drag you out. And I think sometimes most importantly, what people don't think about is that if you don't run a formal process and bring in competition, you'll never really know how much money you left on the table. Now, certainly there are instances where you can negotiate with one buyer, get a blockbuster deal, and would not have done better elsewhere. But I find that happens in the extreme minority of cases. Remember, the value of a business is not, there's no price tag on a business. It's arrived at the bargaining table. Value is subjective. It's a matter of bringing in a wide diversity of acquirers and having them bid competitively to acquire your business.
Right, so I'd just like to say thank you to Paul and all the people at POTOMAC. It's a fantastic sell side M&A Masterclass. And I hope if from a buyer's perspective, you've understood how we need to counteract or at least deal with the situation that a sell side advisor, the sell side process might bring to you when you are on the other side of the table. And of course, there's many other things that needs to be done when you're on the buy side. So carry on watching videos on this channel to learn more about buy side, sell side, but also M&A in general. And I'll see you in the next video.